Good morning. This is John Roush with Holtzman Partners. I'm a tax partner here that leads our practice. It is Friday morning, April 3rd, about 10:15 in the morning. First of all, I hope everyone is doing as well as possible in these crazy times. I don't think any many of us, if any of us, have seen such things going on in the world as we're all experiencing now. So we here at Holtzman certainly hope that you and your family are are healthy and are hunkered down, and hopefully we'll get through this, as well as your business as well. But wanted to just take a little bit of time this morning. We decided that we would just do a recording of some of the information that's out there, as opposed to a webinar with a specific date or time. Just knowing with everyone's schedule and all that's going on, that it just might be difficult for y'all to find a specific hour or so to dial in or dial up and listen in as part to the to this to the webinar. So we decided to do a recording. It's just going to be a slideshow with my voiceover, um, and we'll get this. We're gonna if you're listening to this, you know that it's posted on the website. We'll send an email blast to kind of let our clients know that it's there. But we hope you find this informational and helpful. There is a unbelievable amount of information out there right now, and it changes literally every day. I think even this morning, again, it's Friday, April 2nd right now. Excuse me, Friday, April 3rd right now. Um, just this morning, the whole SBA and payroll protection loans that had some additional changes and curveballs, and new information came out on that just last night or sometime yesterday. I believe the state of Texas has now come out and extended their franchise due date from May 15th to July 15th. So that's to coincide with federal. So there just seems to be new information coming on a daily basis, if not hourly basis. So um, certainly these slides could be a little bit outdated, but we think we have a lot of good information in here that we'll talk through. As always, if you have any questions on this, please feel free to reach out to myself or any of the Holtzman management team, and we will. If we don't know the answer, we will certainly try to find out that answer and help you out in this time of need. Um, what we're really going to try to focus on, at least through this webcast this morning, is really three items. There were some IRS notices that first came out. That sort of was the first wave of this. Came out a couple of weeks ago that talked about the actual extension of the April 15th deadline. We'll talk a little bit about that. There's actually three notices that came out, so we'll talk a little bit about those. We'll get into CARES, which I think is really the meat and potatoes of what's happening. That's the big $2 trillion stimulus that certainly is getting most of the press, as it should. And then we also have some information on the Families First Act that we'll talk about a little bit. That actually came out a little bit before the CARES Act. There's a lot of information in these slides, a lot of writing. We probably won't, or I probably will not go through every single slide and every a bit of detail. We're hoping that it's a good resource for you that might probe some more questions, but we probably won't cover every single topic in here, at least not in great detail. Again, if you do have questions after listening to this or anything else, please reach out to one of the Holtzman management team members, tax team members, your current tax engagement team, etc. We do have, again, if you're on this webcast, you already know, but we have a COVID resource page with a lot of useful information up there that we're trying to be as active as possible, get things updated, because we know this is just moving moving fast and is also obviously extremely important. So with that as kind of an intro or some backdrop, let's jump in. Um, so again, here's the quick agenda. We're going to talk a little bit about the three IRS notices, the CARES Act, and then the Family First Act. So first with the IRS notices, 2020-18. This one was the kind of the first one that came out, that really I think most of us are interested in. Originally, it came out and said that just the payments, for returns that were due April 15th would not have to be made until July 15th. That caused a lot of consternation and questions around, well, I have to file a return or an extension, but I don't have to file a payment, or make a payment until later. That seemed a little crazy, because it's still a lot of work sometimes for folks to get, to even to get to an extension calculation, even if you didn't have to make the payment. So it was shortly thereafter that they IRS issued this notice and essentially said, as you can tell in the first bullet, automatically qualified to defer federal income tax filings and payments of income tax until July 15th. So really, it's a 90-day extension to file and an extension to pay. There's no paperwork that needs to be filed on April 15th. It's really as if April 15th prior years has just become July 15th, for the current year. That also does include, because there was some question about this at first, well, what about my first quarter payment for 2020? Those of us who make those payments, would have had a first quarter payment due April 15th, 2020. And they addressed that, as well, and said, nope, you don't need to make that payment either until July 15th. So we've got a little bit of a unique situation this year, whereas as it stands right now, the second quarter payment has not moved. So that requirement is still June 15th, 2020. And the first quarter payment is July 15th. So little counterintuitive there, but that's how it stands at the moment. That your Q2 payments due 6/15, Q1 is due 7/15, and as I mentioned at the top of the webcast or recording, the state of Texas is also. And I think most of us probably listening to this webcast have some business interest in Texas, if not solely in Texas. The franchise tax has been moved to July 15th, um, instead of May 15th as it is in prior years. So a couple of other bullets, on this particular notice. Filing and payment deadline relief applies to any forms 1040, 1065, 1120, 1041, and any amount of federal income tax payments, that would be due on April 15th. So it's pretty all encompassing. A couple of the items that I haven't seen that they've adjusted yet. Um, the non-for-profits, the Form 990s, which historically for calendar year Form 990 non-for-profit is due May 15th. I have not seen anything that has moved that or delayed that. I imagine that will happen, and hopefully they line that up as well to July 15th, especially since some of the states or a lot of the states are doing that as well. But as of the date of this recording, to my knowledge, that has not been performed as well or moved as well. The notice, that last bullet point, for those of us that maybe have a Form 706, which is really the estate tax return, um, that might be due, that has not been moved. So that if there is a 706 estate form due, that is still due 4/15. So that's kind of was a big one. I think that was the first indication out of the gate that the IRS and Treasury were going to make some changes. And I think that was a relief to a lot of individuals, as well as primarily it affects individuals and C corps, that are mostly do 415 if their calendar year. Um, IRS Notice 2020-20 talks about certain taxpayers automatically qualify to defer their gift or their gift tax returns as well. So if there's gift tax returns that need to be filed or generation skipping transfer tax payments that are due on April 15th, this also moves to July 15th. Probably not as important maybe to our client base, but I'm sure there are some of our clients who have gift tax returns as well. Um, so that's just something to note. That has also been moved to uh, July July 15th. Um, let's skip to 2020-59. These are just some miscellaneous items that the IRS has talked about that they're going to kind of take pause on a few things. Installment agreements, if taxpayers are under an existing installment agreement, the IRS is suspending any payments due between April 1 and July 15th. There's a point there on offers and compromise. Um, they've got some play in there till July 15th. Um, Field and automated collection audits themselves. IRS will generally not start any new field audits at this time. If you're in the middle of a case at appeals, they are having their appeals employees will continue to work cases, however, not in person. So if any of those, if you're in the middle of an audit or in the middle of appeal, I'm sure probably your audit team has been in touch. But if not, certainly maybe reach out to them. The one thing I thought was that I've heard over and over that the IRS is going to really try to make a point to do is to continue to work refund claims. They understand, from my experience and what I've been told, they really are embracing the fact that they need to get refunds out to individuals or businesses, as soon as reasonably possible to help interject that into the economy. They're still going to work refund claims as fast, whether it's under audit or not. So if you are an individual or if you're a C corp or anybody that's expecting a refund and you still want to go ahead and try to get your tax return out, even though you have until July 15th, you may want to get out early. I heard somewhere or read somewhere recently that they were trying to turn those around in as little as 21 days. I don't I don't know what how much of a real anchor that is, but that's been my understanding is that they're going to do their best to turn around any refund claims in 21 days. So moving to the CARE Act, Coronavirus Aid Relief and Economic Security, or commonly known CARE Act, March 27th. So this was really just, Friday, I guess, late Friday, was signed into law. It's just amazing how fast things proceed. Days almost seems like weeks or months now, probably to y'all as well. But this was signed on March 27th, and so that was really just 1 week, probably less than 1 week from where we are right now. We'll talk a little bit about the business assistance side, loans and payroll tax credits. Probably the biggest one that is out there that I think people are talking about and are aware of is the Paycheck Protection Program. Let me read a couple of these bullets and then make some comments on them. Really, at the nexus of this, it's to provide access to loans for businesses, including sole proprietorships, fewer than 500 employees. Loans will have a maximum maturity of 10 years and an interest rate not to exceed 4%. And I believe what I read just yesterday or earlier this morning that right now those loans are at 0.5%, 0.5. So 0.5%. The loans may be used to cover payroll, mortgage payments, rent, utilities, and other debt service agreements. So what they're really trying to do is help the small businesses out because they know that a lot of our businesses our revenues might be affected. Certainly, our cash flow might be affected. So I think the genesis behind this is really to try to kind of help cover those main fixed costs, which for a lot of our businesses are, of course, payroll, mortgage, rent, and utilities. Loans are generally limited to the lesser of an average payroll cost for 1 year ending on the date of the loan, or ending on the date that the loan was made, multiplied by 2.5, or $10 million. So the lesser of those. Obviously, if there's a business that has not been around for a year, there are some rules around that on kind of short period calculations. But these are the general rules, in terms of who's eligible for that. There's also some specific rules kind of in the hospitality and dining industry, as well, depending on kind of your industry classification codes. If you're in that industry, you've got a couple of extra or special rules to consider. Um, again, that's probably the biggest item, is that these loans are available. I know today was supposed to be the day that that was open. Um, my conversations with many banking referral partners and colleagues in the market, it's just been an overwhelming amount of work and analysis and review, as banks are certainly trying to work with their clients to get as much of this in place. I know there has not been a tremendous amount of specific instruction. I think there's still some unknowns in this area as of the date of this recording. I believe earlier this morning I read that um, this may, even though today was supposed to be the first date that it was open, there's just so much to still kind of figure out, that applications still are being taken, but not necessarily maybe processed. And it's probably going to be Monday, the 6th, when this really gets going. Um, so anyway, again, kind of real time changes, because I think everybody was anticipating this to be day one, but it really looks like more like Monday will be day one. Probably another one of the larger portion of this is the forgiveness of loans. Personal loans may be forgiven on a tax-free basis if the business meets certain criteria. So a loan amount may be forgiven in an amount equal to the sum of the following costs incurred and payments made in this covered period, which is the 8-week period beginning on the date of the origination of the loan. Payroll costs, um, that payroll costs do not include any compensation of employees in excess of $100,000. So if you've got some employees that are above that, it will be. It's not that you have to exclude um, them, but you will be. The way the calculation works is kind of knock it down to $100,000. Um, the there's quite a bit of documentation required. I know some of you who probably are pulling this literally pulling the information for the application. Now there's quite a bit to, to go through. That it's no small task to kind of go through this. Um, a couple of items I think is worth mentioning on the limitation of the debt forgiveness is, if there's a reduction in the number of employees, then there could be a portion of your loan that would not be forgiven. And there's some calculations around that and time periods and whatnot. And happy to kind of walk through if you've got some questions and some one-off. Also, the reduction for reduced salary and wages in terms of amounts. So the amount of the loan forgiveness is reduced by the amount of any reduction in total salary or wages for an employee that is in excess of 25% of the salaries or wages of the employee during the most recent full quarter, during which the employee was employed prior to the origination of the loan. So I think in spirit, what they're trying to do obviously is they don't want companies to necessarily reduce the salaries or reduce their headcount. And if there are reductions in those two areas, then there may be a portion of the loan that won't be forgiven. Not that you can't still get the loan, but there just might not be the 100% forgiveness in that area. So again, there's some specific mechanics and calculations around that, but I think that's that those are some of the general rules around that area. So that seems to be pretty hot topic, obviously, and I think that with some hard work and pulling all that, I've heard 50 to 75 pages, maybe more, are being attached. The application itself is not overly difficult, but there's a lot of paperwork, a lot of calculations to attach. But if we can get that in, and get the cash into the business, I think this is a really nice program. It just may take a little bit of effort to get there, and then on the funding of it as well. When the cash actually comes in, but when it all said and done, especially if we can get loan forgiveness on this, it's really a nice program. Um, the the EIDL loans, this is something separate than the SBA that we just talked about. So let's just talk about those a little bit. There's a little bit of difference. It expands the SBA disaster loan program to sole proprietors and ESOPs. No personal guarantee required on loans below 200K. Allows businesses that have applied for a disaster loan to get an immediate advance up to 10 grand, which is not required to be paid. So one of the advantages of this is that if you really need immediate cash, 10,000, you can get in a few days, and is generally not required to be repaid. So that this is another kind of area to look at, the EIDL grants, as you're going through your review of what else, what should you be doing or potentially doing, with respect to this crisis we're in. Refundable payroll tax credits. So there's some tax credits on the payroll side, that are out there as well, available to employers. Operations were fully or partially suspended due to COVID shutdown when gross receipts declined by more than 50% when compared to the same quarter in the prior year. Um, it's this is generally kind of talking about the kind of the $5,000. There's a $10,000 amount per employee, and the credit is really equal to 50% of the wages, of that employee. So obviously 50% times 10,000, is $5,000. So this is another provision that's out there. One thing to note probably is if you do take advantage of this or think you should take advantage of this, you cannot do the PPP loan and this. So it's an either or, and it may be worth doing a calculation on this, to see which might be better for you. Uh, Similar to the next one here, the deferred payroll taxes. This is something that allows employers and self-employed individuals to defer payment of the FICA 6.2% that would be due on December 31st, 2020. And you basically you get to defer that, split it over 2 years, split it into at the end of 2021 and the end of 2022. So this again is another nice provision that might be worthwhile for you, once you do your calculations. There are a few limitations on this provision, allowing for a delay in the payment of the applicable employment taxes is not available to a taxpayer if the taxpayer has had debt forgiveness under 1106 of the CARES Act. with respect to the loan that we were just talking about. So if you get some loan forgiveness, then you don't you are not eligible for kind of this delay of employer payroll tax portion. So there's a lot of interplay with some of these, and as we're all kind of figuring out and learning all this together, um, there's certainly some nuances that we all need to be considering. But this is another item that at least should be thought about. Moving into tax policy changes, a few items more on more of the pure uh, tax world, I guess. A lot of it had to do with the last tax cuts and job act that came out. A couple of years ago, it had, as we all know, had some big sweeping changes. It reduced the C corp rate down to 21%. It introduced the qualified business income um, deduction, the 20% so-called 20% deduction to the flow through, which is for partnerships and sole proprietor entities. So they're made through this CARES Act, they made some tweaks to a few of the items that were in that act from a couple years ago. One of them was the business interest limitation. For tax years 19 and 20, they will temporarily increase that amount of deductible interest from 30% of adjusted taxable income to 50%. So before the Tax Act of late 17, this was not really an issue. But then that came into play. It was basically called the interest expense limitation, and they limited it to 30%. You could only deduct interest of 30% of your adjusted taxable income. Well, what this CARES Act has done as temporarily for 19 and 20 have moved that to 50%. So that could be important for some clients, could be not for others, just depends on the facts and circumstances. Here's another kind of the technical adjustment on the qualified improvement property. It corrects an error that was in the Tax Cuts and Jobs Act of 17 that increased the depreciable life of qualified improvement property to 39 years. So I think there was as we all may remember a few years ago when that was coming into play, the Act of 17, this was one of the areas that we don't think was intended, but ended up getting written into the law that there was qualified improvement property, which really is improvement to to real property or fixed assets, um, were should have been eligible for bonus potentially and depreciate over 15 years. But really, more importantly, they were bonus eligible. But again, the way that the law that ultimately got finalized was that it got captured into the 39-year bucket. And if you're in the 39-year bucket, you're not eligible for bonus. That's obviously the big whammy here. So retroactive, which is interesting, they went retroactive to January 1, 2018 on this, and so there really is no break in the law, because these are kind of how the rules were as of 12/31/17. So this could also be very potentially important and potentially beneficial to some clients that have some qualified improvement property, that are stuck in 39 year or were stuck in 39 years, and that now we could do an analysis, get that into 15, and more importantly, get it into bonus. So again, if you think that you might have some of this or have some questions around this, please feel free to reach out and let's talk about this. Again, very facts and circumstances specific, but if it does fit right, it certainly could be beneficial. The other kind of big one in the business area was the net operating loss change that the CARES Act put into play. So this is, again, depending on your facts, this could be pretty important. And I know we have some clients that fit into this bucket, and I'm sure there are other, non clients that might as well. But basically, if you have net operating losses, which again, is really just your tax losses for 2018, 19, and 20. These can now be carried back 5 years and fully offset income. So if we remember before the Tax Act of 17, um, the, you had NOLs that you could carry forward. Then when the Tax Act came in 18, or excuse me, at the end of 17, you still had NOLs you could use, but they put an 80% limitation on it, and you could only carry them forward. Now what they've done is they've lifted that and said not only can you offset 100%, not just 80%, you can actually go back 5 years. So that could be a great opportunity for some companies, especially since the tax rate has changed. So if you were taxable in the prior years, let's say 14, 15, or 16, or even 17, you were taxable, you were paying in a C Corp, this does only apply to C Corps, you were paying tax at 35%, 35% rate. Well, now if you're in 18, 19, or 20 and you're generating losses, you're under the 20% tax rate. If you can carry those losses back to years where you were paying tax in 35%, it's a real benefit. So there's really just the analysis that needs to be done. Um, laying out what your annual taxable income or loss look like, really for 5 years prior to 2018, and then 2018, 19, and obviously we don't know 20 yet. But if there's losses in the current year and taxable income in the prior years, then that's where the opportunity comes. We can carry back these current year losses, carry them back, file a refund claim, and receive some cash, and have some rate arbitrage in there as well, because we're getting taxed at a much higher rate prior to 2018. So these are a couple really good kind of tax policy changes that all three of those happen to deal with. There was some adjustment in the Tax Cuts and Jobs Act of 17, and these three are now kind of adjusting them, and I think could be quite beneficial depending again on your set of facts and circumstances. Retirement funds. Individuals may withdraw up to $100,000 from their retirement accounts with no penalty if repaid over the next 3 years. Again, typically most of us probably know, as if you pull funds out of your 401k or IRA or other retirement funds, there's generally a 10% penalty on that, in addition to paying income tax. Now, in this, you still will pay income tax if you withdraw the $100,000, but assuming you would have anyway. But there is no penalty tax if you repay it over 3 years. And retirees have the option to waive required minimum distributions for 2020. That would be important as well. So they made some changes to this area to try to help with the pandemic. Charitable contributions made a couple changes here. Allows taxpayers utilizing the standard deduction to claim an additional above the line deduction up to $300 for cash contribution. So as we all know, again, in the Tax Act of 17, they upped the standard deduction quite a bit. So I think the last count I saw was almost 90% of individuals were using the standard deduction, which really meant that there was no real incremental benefit for charitable contributions, or other items that potentially in the prior years would have been deducted. So what they've allowed, for 2020, or beginning in 2020, is you can kind of do an above the line up to $300. So you get your standard deduction, plus $300 above the line deduction for some contribution. And obviously, what they're trying to do there, as we know, cash is tight and businesses are struggling trying to get through this. Usually, one of the first things that are probably cut are charitable contributions, but obviously, this is a way for them to try and keep that going, keep that out there, and hopefully we can continue to fund our charities, because obviously they serve a very vital role in society. Um, they've also suspended the limits on the deductions for charitable deductions for taxpayers that are itemized in 2020. So that deduction has been, or that limitation has been suspended. So again, you've got more opportunity. If you itemize, you have more opportunity um, to contribute to charity and still get a tax benefit. Increases the corporate charitable deduction limit for 2020 to 25%. So it was at 10% on the corporate side. Now that limitation is up to 25. Again, all this around trying to keep charity contributions alive in this difficult time. Some information on individual assistance, rebates, and extended unemployment. We'll talk a little bit about those through these slides. This is probably, again, one of the more popular ones that we've seen that kind of gets the above the fold news. U.S. residents with AGI up 75K, 150 for joint, are eligible for 1,200, 2,400 for married rebate, plus $500 for each child, with phase outs for AGI exceeding these thresholds. So if you get complete phase out, 99 grand for individuals or 198 for joint filers. But if you make less than that, you're going to get some sort of rebate check, and as well as something for each child. Rebates are based on income reported on your 2019 returns or 2018 if 2019 hasn't been filed. And rebate checks will be going out between now basically and December 31st, 2020. I thought I had read somewhere that they're trying to get this all out again in like a 3-week period. And that could have changed since I read the news yesterday, but I thought that's what I had heard. So that's hopefully something. Obviously not a just a ton of money, but certainly to each family that could be helpful in this time of need. Unemployment. It expands unemployment insurance so that jobless workers will receive an extra $600 per week through July 31st, in addition to state benefits. So I think that's again trying to help the economy and infuse with some money. 600 per week through July on the employment side. Benefits also available to independent contractors and self-employed. So so that's really the CARES Act, and I know we went through that fast, and I know we didn't probably even cover half, less than half of what's in there. There is just a lot of information. I think it's almost 900 pages of law, but wanted to try to get the highlights to you. And again, if you have questions, please feel free to reach out. Wanted to talk a little bit as we're kind of coming on the home stretch on the Families First Coronavirus Response Act. So this one actually came out, I guess, 9 or 10 days before the CARES Act. It was signed into law and includes inside it the Emergency Family and Medical Leave Expansion Act and the Emergency Paid Sick Leave Act. Collectively, that's what they're calling it together, Families First Corona Act. This is effective for leave requested from April 1, which was just 2 days ago, I guess, through December 31st. So this is a little bit of highlight in that space. So first one, Emergency Family and Medical Leave Expansion Act. This amends the FMLA Act of 93 to include FMLA paid leave for a qualifying need to a COVID-19 emergency declared. For these purposes, a qualifying need means the employee is unable to work or telework due to the need for leave to care for a son or daughter under the age of 18 if the school or place of work has been closed. So I think all of us are dealing with, especially those with children, especially those with younger children, is probably even more difficult. The schools are closed. I think my particular district, we're closed through, I believe, May 4th at this point. And I just don't see us that this kid's going back at all through the end of May. Obviously, that's a hardship on working parents, especially if there's um, two spouses that are trying to juggle both a job and raising their children. So this is really what they're trying to help with. Um, so in this eligibility, not all employees qualify under this. Specifically to qualify, the employee must have been with a business for at least 30 days, calendar days, prior to the request for leave, and the business must have less than 500 employees. The second bullet talks about kind of a small business exemption if you've got businesses with fewer than 50 employees as well. So the small business exemption, to qualify for this, the business must have fewer than 50 and an authorized officer of the business must determine that. And we can kind of, I won't read through all those detailed bullets, but basically this needs to be, analyzed and looked at, and they're basically to try to get into the small business exemption. We need to make sure we fit the bill here. And obviously the first test is fewer than 50 employees. The FMLA COVID-19 paid leave. If the employee qualifies and elects FMLA leave for a COVID-19 emergency, that the employer must provide paid FMLA COVID-19 leave to the employee based on an amount not less than two-thirds of the regular rate of pay and the number of hours the employee would otherwise be normally scheduled to work. So basically, they're just trying to not penalize the employee, for having too much, for having to basically deal with the real life issues and personal issues of the coronavirus that we're dealing with. The employer is not required to pay FMLA COVID-19 leave for the first 10 working days, although the employee may elect to substitute any accrued vacation, personal medical sick leave, etc. The employer is not required to pay FMLA COVID-19 leave in excess of $200 per day. So basically $200 per day, which is $1,000 a week, or 10 weeks times 1,000, $10,000 in the aggregate. So that's kind of the bullet points on the duration side. The other kind of second piece under the Families First is the Emergency Paid Sick Leave Act. And that's the summary. Eligibility, similar. Not all employees qualify under this piece. Specifically, to qualify for COVID-19 sick leave, the employee must work for a business with less than 500 employees. There is no requirement on this piece that they've got to be with the employer for 30 days. Again, Secretary of Labor has authority to exempt certain small businesses with fewer than 50 employees with respect to the new COVID-19 sick leave requirements, if the imposition of the new requirements jeopardize the viability of the business as it going. So similar to what we just talked about a few slides ago, we're trying to protect the small businesses, and if you've got 50 or less, and ends up, a handful or more of people end up not being able to be part of the business, that can take a much bigger toll on a 50-person enterprise versus a 500 or 1,000 person or more. COVID-19 paid sick leave mandates the employer paid sick time to the extent employee is unable to work or telework due to the following. And again, we can kind of read through those, but basically these are the bullets that talk about that would be covered under the paid sick leave portion of this act. Duration. Full-time employees are entitled to paid sick time for up to 80 hours of work. Part-time employees are entitled to paid sick time equal the number of hours in which the employee typically works on average over a 2-week period. The employer is prohibited from requiring the employee to use other paid sick time available to the employee prior to using the COVID-19 sick leave. So that's a little bit about the duration of that. Payroll tax credits. Again, because under this Families First, because employees are required to pay the FMLA COVID-19 leave and sick leave where applicable, the Act provides payroll tax credits to the employers. Employers can obtain the payroll tax credits through a credit on their quarterly employment tax returns. If the payroll tax credit exceeds the amount of the payroll tax for the quarter, then it's treated as an overpayment and will be refunded to the IRS. So I think obviously what they're really trying to do is help keep our employees employed. But obviously, if our employees are not working, they're on sick leave because of all this horrible thing everyone's trying to deal with. The company is still on the hook for payroll taxes, but what this is trying to offer is some relief of that with payroll tax credits from the employer perspective. Self-employed individuals, Families First also provides leave for self-employed individuals with leave or sick leave equivalents. Self-employed individual is eligible for these if the individual regularly carries on a trade or business and would be entitled to the leave and the sick leave act. So similar rules for the self-employed individual. That's all that I had in the slide deck today. I first and foremost hope everyone is doing okay, practicing our social distancing, and hopefully we can flatten this curve out and try to get back to normal life. We tried to, again, I know there's a ton of information as we're all weeding through and trying to figure this out. Hopefully that was somewhat helpful, or at least have a PowerPoint deck to refer back to. If there are any questions at all, please feel free to reach out to me. My information is up on the screen, or any of our tax management or other partners, and we can get to the right person. If we don't know the answer, we'll certainly do our absolute best. So again, we'll sign off and wish everyone the best. Please feel free to reach out, and hopefully we get through this. I think there are some good things in here, some good opportunities, both on the kind of the rebate and the loan and the potential, or the SBA loan, the potential debt forgiveness, as well as some tax planning around the NOL carryback and qualified improvement property. There are other things that you think might be interesting and potentially applicable. Feel free to reach out and talk. So Friday, so as I'm recording this, so hope everyone has a great weekend, and we'll talk soon. Thank you much. Bye.